Hi, I'm Ian Rogers from Entreflow with part 3 in our 4-part series on managing cash flow for growing companies. In part 2, we talked about how to get more cash in. If you missed that one, please subscribe and go back and watch that before you come here. Let's say your revenue is taking off, but you still need some more runway. That's when we start talking about cutting some costs. You have to be smart about it so that you don't kill your future. Let me give you an example. We worked for a startup. It was a crowdfunding kind of platform, and they'd raised millions of dollars. They had tens of staff. They were going really hard on sales, but it just wasn't taking off fast enough. We saw that they were down to about 1 month of runway, and it was clear that something really drastic had to be done. There was this pivotal meeting one day where we had to go into the management team and say, you're going to run out of money, guys, unless you do something really drastic. So needless to say, it was a very stressful time, but it had to be done. The executive team took action on some of these recommendations very quickly. It was all done very quickly over the course of a couple of days. And within those few days, we had bought them an extra 8 months of runway. So it's possible to drastically extend your runway with some careful cuts. If you're like most companies, you're going to start by looking at your big ticket expenses and seeing what you can do to reduce them. And that's obvious, but I want to tell you a few tips that companies often overlook. So they might apply to you, so please consider them. Tip number 1 is to focus on reducing costs of goods sold. If you're running the kind of business where your margin on each sale is lower than about 50%, then moving this needle could have the biggest impact on your business. So say a 10% savings here could mean double that impact on your bottom line. It depends on your exact margins on stuff, but the point is you can have a big impact here. So examine your purchasing practices, your sourcing practices, set metrics, and see if you can move that needle on efficiency here. Tip number 2 is to take a really close look at marketing and see where you can make cuts there. Take a close look at your cost of client acquisition, your CCA. So if you're like many growth companies, marketing spend is quite high. We see this all the time. It makes sense as an investment in growth, but if you're like many young growing companies, marketing spend is poorly allocated, which also makes sense. No fault here. There isn't a long history to say what works specifically for the innovation that is disrupting your own industry. So you're throwing money away on marketing initiatives that don't work. And that's fine, but it's also an area that if you get expert help on this from an outside marketing consultant, somebody with years of experience and another perspective, they might be able to help you judiciously decide what areas you can cut without impacting your growth. So reach out to an outside marketing consultant, and I mean one who's managed a budget before, not your SEO experts or your social media experts. Someone who's managed a budget, and get measures in place on what's working, run experiments, and allocate budget properly. Okay, tip number 3 is to cut software. So I was once working for a company where I found $23,000 of funds that were basically paying for an enterprise software that was complete overkill for what they needed, and B, paying for a bunch of CRM user licenses that they didn't need because they had downsized their team a little bit. That's a significant amount of cash, and it's often an area that's overlooked. The brilliant part is that you can often add licenses again once you need them. Okay, next tip is to look at the long tail. So this is the concept where you're going to have a few big ticket expenses and then numerous smaller ones in a kind of diminishing curve. So examining and cutting the smaller expenses is more work, so companies don't often focus over here, but they can actually account for the majority of cash outlays. So cut them. So pay a financial professional. You don't need to spend your time doing this. You've got a business to run, but pay an accountant or a bookkeeper to go through with a really fine-tooth comb, and they could save you thousands of dollars wasted on anything from meals to cell phone overages to memberships that you don't need, fines that you shouldn't be spending, etc., etc. And those dollars add up. The final tip is to cut payroll, but do it very, very carefully. Layoffs should be a last resort for growing companies. Do take this opportunity to get rid of dead weight, but keep the good people if you can. It's very costly to grow a team, and you're going to have to hire new people again at some point. So layoffs are also culture killers, so consider some alternatives, right? If it's legal in your area, ask employees if they'd be willing to take a temporary pay cut or to reduce work hours or to trade some measure of their compensation in cash for an equity earn-in into the business. There's some ideas that you can consider. Those are just a few strategies to reduce costs. You also might want to consider the pivot at this point. And by that I mean effectively changing your whole business model. But I can't really guide you through that without talking to you in person. If you want help with cutting costs or with effecting a pivot, then please do feel free to reach out to me or to the Entreflow team. Next time, we're going to talk about timing of cash.